Hey everyone, and welcome back. In today's video, of course, we are doing our monthly edition of Stock Market Q&A. So, as always, every single month, I make a post on the community board of my channel asking you guys for some questions related to stock market investing. So, basically, if you're wondering how you can get a question on next month's video, then the best thing that you can do is be subscribed. And then basically, in your subscription box, every month, I make a post and it will appear in that subscription box. Or otherwise you can manually go over to my channel and click on the community tab and then look for the latest post. The other thing that I want to mention just before we get into this video is that after this video goes out, there may be a lack of videos for a week or so because I'm actually in the process of moving to a new apartment. So in that process, I'll need to be moving my recording studio from where I am now, of course, to the new apartment. And as a result, there may be a period where there are no videos. It's probably going to be a week at the most, maybe 2 weeks, I would say would be the very most. But that's what you can expect over the next couple of weeks. And I do apologize for the lack of videos after this. But other than that, I think we should get straight into some Q&A. So the first question that we have for today is from Nolan. Do you ever feel that you get wrapped up in the numbers when analyzing a company? Yeah, absolutely. And I think that particularly for some people, the numbers is sort of, it comes a little bit more naturally to some people. And I think that with sort of a mathematical finance background, that's kind of where I find myself. And often I find myself looking at the numbers for too long. And in reality, I think that the numbers are only a very small component of the overall analysis picture. And I think that people would be much better off if they spent much less time on the numbers. Of course, making sure the business has growing profits, growing revenues over time, low levels of debt, and that sort of thing. But ultimately, you want to spend the majority of your time developing a good understanding and overall picture of the business and its industry. Because your ability to understand how these businesses make money, how they supply their products, how they manufacture them, how they distribute them, how different businesses compete against each other in different markets, all of that sort of understanding and coming up with a clear picture of what the industry and the businesses look like within it is what will make you a good investor, allow you to interpret the numbers more accurately. But certainly I do feel that from time to time, it's easy to get caught up in focusing on just looking at companies with really, really good numbers. The second question that we have here is from Kyle. Hey Hamish, first off, thank you so much for taking the time to put your knowledge out there for others to utilize. No problem at all. So your question is, what portion of your portfolio is in either the US or other stock markets? And what is your preferred platform to trade on them? Thanks again. So in terms of the platform, that's probably the easier question, so I'll start with that. I do both my Australian and my international trading and investments through CommSec, so through Commonwealth Bank's major platform. And I do recognize that there are many other lower cost alternatives that have lower brokerage or better exchange rates than Commonwealth Bank. But for me, paying a little bit more for brokerage in combination with investing through a bank that is very highly reputable. It's been around for many, many decades. It's very secure, and there's physical branches that I could go to if I was having any problems with my money. That kind of is the trade-off that I'm willing to make. I'm willing to pay up a little bit more for those added features. But I know that for a lot of people, and it also depends on how much money you're sort of operating with. If you're operating with a relatively small amount of money, then going with something like Stake might be a good option in order to have no brokerage fees. But for me, I sort of just prefer to keep it all in one place, so it's nice and easy for me. And it's also with a highly reputable bank in Australia. And in terms of the percentage of the portfolio, I'm actually not sure. Let me go have a look. Okay, so of the stocks in my portfolio, so excluding cash completely from this equation here, just of the stocks that I have in my portfolio, about 36% is in the Australian market. So there's two individual companies and then the index fund that tracks the Australian market. And then the remaining 65% or so is invested in the US market. And I don't have any other investments in any other markets. It's just the US market, the Australian market, and then a little bit of cash. The next question we have here is from Ma. I'm from Singapore, and how can I find the risk-free rate? Great videos, keep it up. Well, thank you very much. In terms of where you can find the risk-free rate, so typically what we're going to be using when we're putting that into the spreadsheet is the 10-year US Treasury yield. So if you just Google search US 10-year or 10-year US Treasury yield, you'll be able to find a number of different websites. The one I typically go to, because it's usually the top one, is CNBC. So you just click on it and it will tell you the latest rate, which at the moment I think is about 0.7% or something like that. But most of the time, I would say, for me, it's all the time, I'm using the 10-year US Treasury yield. And the reason why is because the US government has never defaulted on their bonds. And as a result, they are the gold standard in terms of what is classified as risk-free. The next question that we have here is, how do you calculate a good time to sell when using value investing methods? Yeah, so when you're using sort of the methods that I talk about on the channel, ideally, in an ideal world, when you buy a business, you never want to have to sell it. You want to find businesses that you truly believe through all of your research that it will be a company that will continue to thrive, not just for the next couple of years, but for the next couple of decades and beyond, so that you can just continuously invest into that business and have it as a one of few businesses that you've invested your wealth in. But that's in an ideal world. And in a not so ideal world, things change with businesses that you're invested in. And it really, for the most part, comes down to one of the 4 key pillars that we look at when we're analyzing businesses. So do we still understand the business? So some businesses, think of something like Amazon, has moved into a lot of different industries. So if you're invested in Amazon, you need to deeply understand not only the industry that it was previously in, e-commerce, but all of the new industries that it's moving into. And if you don't understand how the business makes money in those areas or how those industries function, then you would want to sell the business. And the same thing goes for each of the other pillars. So does it no longer have competitive advantages? Is management no longer being honest with you, or are they no longer skillful at their job? And then lastly, of course, the price. So if the price gets very, very high and the return is no longer good, and there's another opportunity available that has a better return, a substantially better return, then again, you would want to sell that business or sell a portion of it and use some of that money to move it into an investment that's offering a better return. The next question that we've got here is, hi Hamish, what are your thoughts about almost all the overvalued blue chip stocks? Do you think they deserve to trade at a premium, or is the premium too unrealistic? Visa is a good example. Yeah, so the reason why businesses overall, at least generally speaking, looking historically, the reason why they're so expensive is because interest rates are so low. The alternative investment at the moment, the risk-free alternative investment, let's say, is probably like 0.7%. So if you can make a 3% long-term return or 3% return over the next 10 years on a stock, then investors are taking that because the alternative sucks. So the argument for why, so really the point that I'm trying to make here is that business prices are justified if interest rates stay low for a very long period of time. And whether interest rates will stay low is not something that we know. We cannot predict what will happen in the future for interest rates. If interest rates go up substantially because maybe inflation picks up and the Federal Reserve needs to try and keep inflation down, so they raise interest rates, that's going to have a lot of downward pressure on business valuations. So that would be sort of a scenario where business prices would come down. If interest rates stay low for a long time, then business prices could stay high for a very long time. So when you say, do they deserve to trade at that price? It really depends on what kind of return you're targeting. Because if you're targeting a 3 or 4% return over the next 10 years, then there's tons of opportunities that you could invest in businesses. But if you're trying to make a 15% return, then the number of opportunities are very, very limited, and you have to do quite a lot of digging in order to find those opportunities. The next question that we've got here is your opinions on investing in Tesla and its future. Yeah, so I haven't spoken about Tesla in a while, actually. And the last video that I did on Tesla, I think I offended a few Tesla shareholders because I started that video just by blatantly saying, no, I'm not going to be investing in Tesla. And basically, I mean, in terms of my thoughts, I really like the company. I like what they're doing. I think they have something unique that they're bringing to the market. There is a huge opportunity for them to monetize their Tesla owners in the future, not just when people buy the car, but having a yearly subscription, for example, for autopilot, for autonomous driving, or having subscription services for other things in the tablet, such as games or movies, or I don't know. There's probably so many things that I can't even think of. It's kind of like thinking about what the Apple could put on their smartphone in terms of apps before smartphones even sort of existed, or just at the beginning of when smartphones existed. The opportunities are really endless in terms of what that car can then be used for if you don't have to be driving it, and it's got a sort of a tablet console in there that has the ability to connect to the internet and run a variety of applications. So in terms of the business itself, and that doesn't even get into their solar business or their battery business. So their business is it's fantastic. It's tremendous. It's a great business. The problem with why I don't invest in it is because I can't see where it will be. I think there's a huge chance that it could be a huge success, but there's also a chance that there's a lot of competition in that space in the future. That competition actually isn't that far behind. And as a result, because I don't know what the future looks like specifically in terms of where Tesla will be, whether they'll be number one or they'll just be amongst a bunch of other businesses, I can't invest in it. And that doesn't, it doesn't mean that I don't think Tesla will be successful. It just means that I only invest in things where I have a very clear vision of where this business will be in the future. And I can compare where that business will be in the future to the price that I pay today. That's something I can't do with Tesla, but I'm very fascinated to watch Tesla unfold over the next decade and beyond, and I'll probably be a Tesla owner myself at some point in the next couple of years. The next question we've got here is, please do tell us what percentage of your portfolio is in cash. That's another good question. I don't know off the top of my head, but prior to... So I made a video talking about this, and I can't remember the numbers specifically, but prior to the March crash, I think I was in about 60% cash or something like that, 65%. Then after that sort of sudden drop, I deployed quite a lot, and I was back to about 30% cash. And then since then, the stocks in my portfolio have gone up substantially. So what that means is that I did have 30% cash, but because the stock part of the portfolio has expanded, the cash part becomes a smaller percentage, even though the dollar amount in cash hasn't sort of changed too much. It's gone up a little bit because I've generated income from my business and put that into my portfolio, but the percentage amount has actually gone down. And I would estimate that it's probably about 20% or something like that. Maybe 20 or 25%. So, I have substantially less cash than I had previously, and I'm kind of happy with how that is at the moment. The businesses in my portfolio, I think, are still at prices where they could continue to go up, even though they've gone up quite a lot over the past couple of weeks. I think many of them could continue to go up a bit, but there would be a point in which, if the market just continued to go up at a huge rate as it has over the past couple of months or the past month or so, if it continued to go up at a huge rate and the stocks in my portfolio went from 3x over the past couple of months to 5 or 6x, then I'm looking to start to sell those and get into a little bit more cash to wait for another opportunity to come. But I really don't know if that's something that we're going to see. We may very well see the market continue to go up, or it may sort of it may come back down again towards the end of the year. And then the final question that we had here is, it's completely related to what I just said, but where do you think the ASX, the Australian market, is heading from here? Up, down, or sideways? Yeah. And kind of how I alluded to at the end of the last question, I have no idea. I mean, in terms of the long term, if you're asking me where will the ASX be in 10 years, where will it be in 20 years, where will it be in 30 years? On all of those, I will say that it will be higher. I don't know specifically, but it will be higher. I'm very confident that it will be higher. I would be quite shocked if the market wasn't higher in 20 or 30 years. But in terms of, I guess, your question's probably alluding to what do I think the ASX is going to do over the next 6 months or the next 12 months, or at least in the short term. I have no idea. I have no idea, and I don't need to know what the market's going to do. If stocks continue to go up, I will benefit from the businesses that I have in my portfolio that, as I just said, is probably about 80 or 75% of my portfolio. And if businesses come down, then that cash position will become a larger percentage, and I'll be deploying some of that into those businesses at cheaper prices. But I have no idea what it's going to do. It could do any of those three. It could go up, it could go down, or it could go sideways for a very long time. So that is all the questions that we had time for today. And as always, thanks everyone for submitting a question. And as I mentioned at the beginning of the video, if you do want to submit a question, then the best thing that you can do is, first of all, be subscribed. And then just keep an eye on your subscription box in about 4 weeks' time. And in about 4 weeks, I will make that post. And if you're in quick, you can ask a question and you can get your question on these monthly videos. But I hope everyone enjoyed this. Let me know your thoughts on any of the questions or my answers to them down in the comment section below. But other than that, I will see you guys in the next video. See you later, guys.